Hello, guys. Thank you for staying. There is another panel coming, more interesting than mine, for sure. And that's about the current banks.
More interesting than this.
Yeah, look at him, yeah. Today we talk about how banks can use tokens to make some money. It was a discussion, I think, yesterday about FIDA and about how banks can monetize data. Your data, our data, their data. And now is, well, you know, we have a lot of banks, right? In Europe, we have 4,000 banks. US has 4,000 banks. Romania has 40 banks, a lot. That's why the consolidation.
Only like 25 now or 30?
Actually, yeah, so it's getting less. So we have, in this panel, two super duper guys here, physically present. And this is Felix Kričan, and the other one is Bogdan Almashi. They probably know them, right? So it's Netopia and Asseto. And they are crypto guys. So when banks, at least in Romania, hear of crypto, they go crazy. They don't want to talk to them. They don't want to talk about tokens. And we have someone else in the panel online, and this is Anthony Rawls. He works for Ripple. And he is also kind of crypto because Ripple is also a crypto guy. But Anthony contributed to a piece of paper called Banking on Tokens. Idea is that what if banks will start to tokenize deposits? So you will see your saving account, deposit account as a token. And I will ask first Anthony Rawls, to explain, because he contributed a paper, what they wanted to do like that, how they see traditional banks, neobanks making money out of tokens. Because, you know, this is real life, okay? So it's not just technology. It's about bank on tokens. Initially, I thought of banks on steroids, you know? So, Anthony, are you with us? Yes. Ah, here you are. Hello. We haven't met, but here you are. So, can you tell us a little bit about the paper that was prepared by your Digital Euro Association, right? And you try to find a way for the, let's say, existing banks, how they can monetize data. Because, you know, they don't make a lot of money. Even the profit in Romania for some of the banks is huge, if you ask me. But they still sit on a lot of data. It's a lot of data. I mean, the banks, and the problem is how they can make more money. And you guys, because you are bankers here, how you can make more money using tokens, using this technology. And I'll ask Anthony to let us know more about it. Thank you.
Thank you. So, just to frame the paper, it was in response to some of the work the Digital Euro Association have been doing around CBDCs, and the interest shown not just by the central banks but by commercial banks about what does that mean for them in potentially a new tokenized world. And so when we look at money, what we tried to do first in the documentation was actually look at the different types of money in circulation and sort of try and break it down. There's already policies and regulation in space for things like e-money. There is already regulation in terms of central bank money and governance and commercial bank money. And when we looked at this is essentially creating digital commercial bank money. It's taking it and actually making it digitally native. What does that mean? Well, if we look at most core banking systems and core ledgers today, it's essentially a digitized version of paper ledgers. There is messages that go backward and forward between each other. And so the promise here that we're thinking about and we were starting to investigate here is if you could tokenize deposits, that could be either through backing your deposits by a CBDC held with the central bank on the central bank's ledger, or some other tokenized bank deposit through loans or other credit lines, how you could use that as part of the sort of commercial bank business today in a way of actually creating innovation and creating truly digitally native money that has a whole host of properties that you can then use, like programmability. So you can start to build innovation in at the money level rather than having to build overlay services that essentially bridge multiple systems.
Excellent.
So that was kind of the premise of the paper, looking at the types of money in circulation and where there's an opportunity to potentially tokenize commercial bank money.
Excellent. So what you say, because the central banks, they cook the CBDC, this is the reaction of the commercial banks to do something about it, right? And I'm looking here at Bogdan and Felix. They are watching like hawks what you said, and they probably have something to say on that. Do you see Netopia tokenizing transactions, or do you see them?
Well, first of all, we should be very clear that when we talk about tokenizing, we can tokenize some assets or, well, any kind of assets which are in one
Bank
way.
Deposits are assets, right?
Yes, assets, but if on this respect transactions, we will not be able to tokenize ever. And when we talk about, I was just thinking now that this is not the first time when banks try to tokenize something and it horribly failed. Let's remember the GFC, where we had all these collateralized debt obligations which were sliced and diced and sold in pieces. So from this point of view, I'm not very, although I'm philosophically against CBDCs, I think that let's rather do the state do this than have banks package some things which are coming with different risk levels and different risk profiles and address to different type of customers and sell them.
So what you say, they should stop even thinking of tokenizing assets because it won't work, won't fly, won't do any money out of it.
No, if we are talking about like having like homogeneous assets, yes, so you have, let's say, bank deposits, and you want to somehow, assuming that I don't know, there are some restrictions from the central bank in what way you can use these assets, then if you tokenize it, then they can be, I don't know, used as collateral for something else, then maybe in this respect, yes, I'd see a use in tokenizing. But other than that...
so there is
yes.
Some hope, right?
Yeah.
What do you think, Bogdan, please?
First, I would say that it works. First, I would say that this kind of financial instrument, or I don't know what it is, these tokenized deposits are as useful as a diesel injection system is for an electric vehicle. And I will tell you why. Because first, we need to understand why tokenization appeared. Because we have many classes of assets in this world which are not liquid. For example, and the most known example is high-value real estate assets. These kind of assets are not liquid, so we need tokenization in order to use these tokens to transform somehow these kind of assets into commodities. And of course, commodities, being like commodities, this brings more liquidity and make it more affordable and easily to be traded. So in this case, what should I understand? That bank deposits are not liquid? I think they are, right?
Maybe there are deposits that have a certain maturity and the people that hold these deposits want to use them as collateral for something. And it's not very easy today to use as a deposit that you have that has some certain restrictions, so you cannot take it out of the bank easily to use it as collateral for buying a house.
So guys, you hear someone hating, or not hating, but didn't like very much the banking, and they come from the crypto, and they started to see value in tokenization of bank deposits, which is a good sign. And I didn't expect them to be so nice. Assetto, a few words what they do, and Bogdan, you correct me if I'm wrong, but he just mentioned that purpose of their platform is to tokenize real assets, real estate, which is a nice thing to do, right? Probably I think that the purpose, and I'll ask then Anthony to intervene, is that tokenizing the deposits and maybe other instruments later on, the banks can make some money out of it in the future. And maybe, Anthony, you can give us some hints of how they can make money out of it. Are you there?
I think, from a perspective of thinking about the money that's in circulation today, the vast majority is commercial bank money through generally credit creation based on deposits and other instruments. What we're talking about here is basically just tokenizing that and making that, removing friction, enabling innovation on what commercial banks currently do today. So this could be issuing a stable coin that's backed by reserves that they hold. It could be tokenizing deposits. They all start to look very, very similar based on what do they hold on their ledgers today and enabling that to have a different set of properties that is potentially richer in terms of functionality. So if we look at today the friction of doing domestic payments as an example between bank account and bank account, that opens up to a whole new set of capabilities that are not possible today, not without a lot of work and a lot of cost. So part of this, back to your point about sort of making money, is actually potentially reducing their costs, which means they can do more with it. So it's about optimizing the way value moves. It's not about, I mean, you can create more value from that, and they will come up with inventive ways and new products to leverage their balance sheets. But this is about giving them a set of properties that allow them to do more with it and be more flexible with it and potentially have more control over it, which is a good thing from a regulated space of knowing exactly how it's being used and what it's used for and the conditions of use.
Can you give us, Anthony, an example, one of the banks in the world already doing that? Because I know a few, but maybe you, from Ripple, you have seen more, and if you can give us an example of tokenized deposits.
Okay, so perhaps not one off the top of my head, but when I look at it, there's a lot of sort of fairly sort of sizable banks looking at how they can tokenize their balance sheet. But there are also commercial banks looking at tokenizing and creating stable coins based on reserves that they hold, maybe through deposits that are entered into their system. So those banks are looking at creating a new framework, a new commercial framework for their customers to interact with each other and potentially for cross-institution interaction. I think probably the best example, just thinking about it, is probably JP Morgan. When you look at the sort of JPM coin, essentially creating a more fluid mechanism for customers of JP Morgan to move value around across border. So you start to remove friction and you start to reduce the cost on that and make it a far more liquid movement. So I think they're kind of the sort of trailblazer in this regard, and I think you'll see others start to do this, where they have problems of liquidity across border potentially, but also within their customers and within the geographies that they operate in for their customers.
So you gave the example of JP Morgan, which is the largest bank, right? So what do you think of that?
I have a connected somehow example, and I'm going back to the Silicon Valley Bank. And remember that in Silicon Valley Bank, their problem, their lack of liquidity stemmed from the fact that there was a mismatch in the duration of the treasuries that they were holding versus the deposits. And in that particular case, if they would have been able to tokenize some of the treasuries that they were holding against, they were the so-called hold to maturity. Once you are able to hold to maturity, you don't lose money. But if you are forced to sell these treasuries before they are mature, then you'll for sure lose. So if they would have been able to liquidize these treasuries before they became mature and sell these tokens created through interested parties, then maybe the bankruptcy would have
So
been
what you say, maybe the Silicon Valley Bank, well, they couldn't make more money, but they can save.
yes,
And they can save themselves from bankruptcy.
yes, and
That's interesting. So guys, you know, if you are on the bridge or the brink of bankruptcy, just tokenize your assets.
Yes.
That's what Felix says here. And it's very, I mean, I really like it.
Also, if you consider this BTFD program that the Fed has, it's in some way it's exactly this, because they are offering the banks the means to tokenize $1 worth of treasury that it's mature in 20 years with $1 of Fed money that is liquid today.
Okay, I go to Bogdan. I know you are mainly about, you know, tokenizing real assets, real value, not just deposits or, you know. Do you see any way for, you say they should stop tokenizing at all, I mean, but maybe you change your mind.
No, I would tell you, I need to explain my first sentence with the useless of this kind of instruments. Why? Because I feel that we talk too much about this kind of banking product. Maybe we should talk about the entire business model, and this is why I asked earlier the guys from the digital banks about the innovation. Because it's very difficult. You know, I will continue the parallel with the electric vehicles. The best electric vehicle in the world is Tesla, which was designed and manufactured from scratch as an electric vehicle, and is much better than other manufacturers which tried to change. But why I make this parallel? Because if you want to build the real banking 4.0 institution, the real 4.0 bank, I think you should start from changing the business model, because financial intermediation, when you use a blockchain network, which is a decentralized network and makes middlemen useless, you should design your business model as a facilitator, not as a middleman. And I think this is the main challenge for the banks and for the banks of the future. They should change their business model. Of course, the revenue streams will be different, but also the services and the products will be different. And why should I deposit my money? Why should I give my money in the custody of a bank on a decentralized deposit when I have a custodian wallet and I keep my money? And I don't speak about crypto. I'm not a crypto guy. I'm a blockchain guy. Maybe Felix is more crypto than me.
Thank you very much. I appreciate. You are not a crypto. Okay, you are just a
So I don't need to deposit in the future kind of banking, in the real banking 4.0 system. You don't need to make deposits. You don't need a custodian to keep your money.
Okay, I got it. So guys, we have 2 minutes. You know, I'm a CBDC guy. I think that central bank digital currency, which is not electronic currency, is not what we have on our plastic or in our current accounts. CBDC is I think it's a good thing. These guys, they hate it because they say state will have control. You talk about programmable money, and everyone will know how you spend your money and so on and so on. But this is not true, in my opinion, of course. I think that CBDC can be, has two faces. It can be a wholesale, or it can be just electronic money of the central bank. So you can have it in your wallet. You don't have it in a bank account, like you say. And probably that's a disruption for the commercial banks. We'll talk about that maybe in another story, but CBDC is coming. Digital euro is very advanced. There are digital currencies in other parts of the world, and we see Asia, Pacific. We see countries in Africa, and we laugh at them because we say, you know, they are behind the schedule, or they are, you know, underdeveloped countries. But actually, it's a good place to start and check and test. Digital euro will come probably 26, 27. We will have it in our digital wallet, and this is very interesting. And you can use it offline. right? So you have your phone, you have your digital identity on your phone. I'm not talking about the plastic card, and you have the money on your phone. Okay, it's limited to 3,000 euro or equivalent, but that's so important. So you don't need anything. You need your phone. And actually, guys, our digital identity or digital footprint is our phone. It's not us, it's not our brain, it's our phone. And as you know, and I look at you, 40% of you look at your phone right now. Okay, so imagine everything is in there, but more than that. So having digital assets is coming. Bank can do maybe more money on trying to tokenize or put on steroids whatever they have. Because people like we have here, one day they will say, I can start a bank tomorrow. And not the bank, the neobanks you have seen in the morning. And my view is that the current banks, the existing banks, and you will see some of them coming on this stage, they will stay. Whatever people say about artificial intelligence, about digitalization, about everything, people want to interact. People want to talk to a banker, to talk to a financial advisor. They can get more advice in advance, but they still want to talk. One example, and I finish, is Japan. In Japan, 70% of people go to an office just to socialize. They go to the banker to socialize. And they are one of the most advanced countries in the world. So digitalizing is good. Having everything on a token is fine. Imagine your identity as a token, stored in a bank as a digital asset.
In a bank?
That could be
stored
awesome.
In a bank?
Yes.
Why? In a bank. Why do I need a bank to store my identity?
Yeah, you see. All right. So, Anthony, are you still there?
I am, yes.
Yeah, so, okay, times is up. So what else is coming after this, tokenizing thing? Do you think that finally banks will tokenize anything in the future? Or they will stop dreaming and forget about it?
So no, I think tokenization is here to stay. I think if we tokenize assets, we need a settlement asset that's tokenized in order to get the benefits from it. Otherwise, you're just only doing half of the innovation. So the projects that we're working on, we're working with all the central banks, commercial banks, who are looking at creating a new ecosystem, a new level of innovation, new product offerings. So I think we've barely scratched the surface, and every project I look at, it feels a bit like we were with the internet in the 1990s. We kind of understand the potential, but we haven't realized it yet. And it took us 20 years to get social media and all of these kind of things. So I do think we're in that kind of inflection point of people understanding it and then thinking about how they can evolve and innovate.
Yeah. So what you say, banks are happy with the digitalization, with digital identity, with KYC, AML, and maybe one day they will start thinking of that. What do you think, Felix? What the banks will do? You are not a banker, but still.
I'm not a banker. I think tokenization is good when we talk about two things. One is time, and then the other one is money, but money as a proxy for liquidity or for size. So when we talk about things which are, as my example with the bonds, which are too far in the future, then you can tokenize them and you bring them forward. Or if it's something that is not liquid, like a very big building, then again you tokenize it and you make it swallowable by many people.
Cool. Time and only specific instruments.
Short. The focus in capitalism is on capital, and this is wrong. The focus should be on the wealth, the main sources of wealth. And the main sources of wealth are the revenue-generating assets. And the problem is, and this is why we have a huge concentration of wealth, and which is an unfair system in the world, is the fact that these sources of wealth are not accessible. And tokenization will do this, will make all these kind of good investments accessible. Because, sure, money is a very strange commodity. As big is the amount, or bigger is the amount, bigger is the price you get on them. When you talk about any other commodity, is the way around.
It is about commercial money. If it is central bank, money is different. There is no interest. So thank you very much. If you have questions, these guys are crypto. No, they are not crypto, but they are in the tokenization.
Yes, I'm crypto.
This is the real
I'm
technology.
blockchain.
You cannot escape it, okay? So tokenization comes after us. It's not digitalization, it's the next level, right? Okay, thank you very much.
Thank you so much. Guys,
Thank you.
round of applause for the panelists. Well done, Nick.